What if I told you that the house you're living in right now could be the key to building real wealth through real estate? What if that invisible money sitting inside your walls, the equity you can't see but definitely own, could help you buy your next home without spending years saving for another massive down payment? I'm Felix Chan, realtor and mortgage broker with the LiveInnerCity Real Estate team, and today I'm breaking down how to use your home equity to buy another property in Canada. Whether you're upgrading to a bigger family home, buying a rental, or relocating to a new city, the equity in your current home might be the bridge that makes it all possible. Let's start with some numbers that might surprise you. In Toronto, the average home price has jumped from $932,000 in 2020 to $1.067 million in 2024. That's $135,000 in new equity for the average homeowner. And right here in Calgary, prices have climbed from $452,000 in 2020 to $612,000 today. That's $160,000 in equity for anyone who bought just 4 years ago. Now, here's what most homeowners don't realize. There's more than one way to access that equity. And choosing the wrong one could cost you thousands or even stop you from qualifying for your next property. So, over the next few minutes, I'm gonna walk you through the complete process using real Canadian data, current lending rules, and actual qualification examples. You'll learn the 3 main strategies to access your equity, how different provinces handle taxes and regulations, and see step-by-step examples of how this works in real life. Now, here's the thing. The current lending environment, it's tougher than before. Canada's banking regulator, OSFI, has set the qualifying rate at the greater of 5.25% or your contract rate plus 2%. That's what's known as the stress test, and it plays a huge role in determining what you can actually qualify for. And I'll explain exactly what this means in just a minute. But here's where the opportunity lies. Even with all these rules, Canadian homeowners can still borrow up to 80% of their home's value. A HELOC, or home equity line of credit, allows up to 65% of that amount specifically. More on that in just a minute. And there's one mortgage feature most homeowners don't even know exists that could save you thousands in interest when moving up to your next home. It's called mortgage portability. Now, most people think that when you sell your home, you just have to pay it off and start fresh with a brand new mortgage. But that's not the case. Mortgage portability lets you transfer your existing mortgage with the same rate and terms to your new home. Now, this usually has to happen within 60 to 90 days of selling your current place and buying your new one. But here's why it matters. Assuming you got a 5-year fixed rate mortgage and you locked in a low rate back in, say, 2022, and rates are much higher now. So breaking your mortgage could mean paying a massive payout penalty. Instead, you can port that great rate to your new home, add a top-up mortgage for the difference at today's rates, and end up with a blended rate that's lower overall. That means more money saved, less stress, and a smarter way to move up without wasting the equity you've already built. Understanding home equity and current market context. Before we jump into the strategies, let's get clear on what home equity actually is and why it matters more than ever in today's market. Let's start simple. Home equity is the difference between what your home is worth and what you still owe on your mortgage. So if your Calgary home is worth $600,000 and your remaining mortgage is $400,000, that means you've built up $200,000 in equity. Pretty straightforward, right? Okay, but here's where it gets interesting, especially with what's happening in the market right now. Let's look at some real numbers from September 2025. In Toronto, the average home price is around $1.06 million. In Vancouver, it's $1.25 million. And even in more affordable cities like Calgary at $615,000 or Edmonton at $452,000, homeowners have built a ton of equity over the past few years. Here's the opportunity. If you compare Calgary's average home price of $615,000 to Vancouver's $1.25 million or Toronto's $1.06 million, the gap is huge. That means a Vancouver homeowner sitting on built-up equity could potentially buy 2 Calgary properties or one multi-family investment with the same amount of money tied up in their one home. That's the power of equity. When you understand how to use it strategically, it can completely change your financial trajectory. But equity alone isn't enough. You need to know how much of the equity you can actually access, and that's where Canadian lending rules come in. And this part is crucial to understand before making your next move. Here's the key rule you need to know. In Canada, you can borrow up to 80% of your home's value. That 80% can be split between 2 things: your mortgage, either a fixed or variable rate, and something called a HELOC, a home equity line of credit. Here's how it works. A HELOC lets you borrow up to 65% of your home's value, but when you combine it with your existing mortgage, the total cannot go over 80%. Let's break that down with an easy example. If your Calgary home is worth $600,000, the maximum total borrowing allowed is $480,000. That's 80% of $600,000. Now, your HELOC portion, the flexible part, can't be more than $390,000. 65% of $600,000. So let's say you still owe $350,000 on your mortgage. That means you could borrow up to $130,000 more through your HELOC, because $350,000 plus $130,000 equals $480,000, the full 80% limit. And since $130,000 is below the HELOC cap of $390,000, you are still in the clear. Think of it as 2 buckets that can only hold so much water. One bucket is your mortgage, the other is your HELOC, and together they can only hold 80% of your home's total value. But the HELOC bucket is smaller, so you can't fill it all the way without spilling over the limit. Now, here's where things get a little bit more challenging. With the Bank of Canada's overnight rate at 2.5% and prime rate at 4.7%, borrowing costs are a lot higher than they were just even a few years ago. That means it's not only more expensive to access your equity, it's also harder to qualify for it. And that brings us to one of the most important factors that determines how much you can borrow: the mortgage stress test. It's a rule that can make or break your ability to use your equity effectively. The mortgage qualifying rate, better known as the stress test. It requires you to prove you can handle higher payments before the bank approves your loan. Here's the rules. You must qualify at the greater of 5.25% or your contract rate plus 2%. The contract rate is the rate you actually get from your bank. So if your bank offers you, say, 4% mortgage rate, you'll need to show that you can afford payments at 6%. That difference might not sound huge, but it can dramatically reduce how much you're allowed to borrow. This is why understanding these fundamentals is so important. They don't just influence what you want to do, they determine what you can do. And now that you know the rules of the game, let's get into the fun part: the 3 main strategies for accessing your equity and using it to build wealth. There are 3 main ways to tap into your home equity in Canada, and each one comes with its own pros and cons and best fit scenarios depending on your goals. Let's start with strategy number 1, the home equity line of credit, or HELOC. So what exactly is a HELOC? Think of a HELOC like a credit card that's backed by your house, but with a way better interest rate and far more flexibility. Here's how HELOCs work. You can borrow up to 65% of your current home's value, minus whatever you still owe on your mortgage. The best part, you only pay interest on what you actually use, not the full limit, and you can pay it back or re-borrow whenever you need to, with no penalties. Now, what are HELOC rates based off of? They're tied directly to the prime rate. So as of recording of this video, most major banks in Canada have a prime rate of 4.7%. So when you hear on the news that the Bank of Canada is adjusting rates, this is what they're talking about. And by the way, the prime rate, it does not affect fixed rate mortgages, only variable products like a HELOC or variable rate mortgage. Now, typically HELOCs are priced at prime plus 0.5 or 1%, meaning your effective rate lands somewhere between 5.2 and 5.7%. Some banks run short-term promos where they'll offer, prime rate or maybe even slightly below for the first 6 months to a year. Let's look at what some of the big Canadian banks are offering right now. And just remember, rates may change by the time you watch this, so always double check or reach out to our mortgage team for current numbers. RBC Home Line Plan. This combines your mortgage and revolving line of credit at the prime rate at 4.7%. TD Home Equity Flex Line lets you mix revolving and fixed portions, both tied to prime plus a spread. BMO Ready Line, a readvanceable mortgage where your available credit grows automatically as you pay down the principal. Scotia Step Program. Super flexible, you can mix multiple mortgage segments at different rates alongside your line of credit. CIBC Home Power Plan automatically rebalances between your mortgage and available credit as you make payments. Now, all of these give you flexibility and liquidity. And for a lot of homeowners, that's the key to getting started with a second property or renovation project without touching savings. But what if your bank says no to you pulling out equity? What if you're self-employed? What if your income isn't perfectly predictable or you just don't fit the standard lending box? That's where our next strategy comes in. Alternative and private lending options. So this is where the parallel lending system comes in, made up of alternative lenders, credit unions, and private lenders known as MICs, Mortgage Investment Corporations. These lenders play by a slightly different set of rules, which can be a game changer if you don't fit the traditional bank mold. Credit unions, for example, tend to be more flexible. Desjardins offers HELOCs with softer qualification requirements. Vancity provides home equity loans that focus on your available equity, not just your income. East Coast Credit Union has a total access home equity line designed for homeowners who want to unlock capital without the red tape. And Innovation Federal Credit Union offers HELOCs with broader qualification options for residential properties. Then there are private lenders and MICs like Alta West Capital, Alpine Credit, Atrium MIC, and Bridgewater Bank. These groups care far more about your equity position than your employment. While big banks typically want to see a credit score of 680 or higher, alternative lenders might work with borrowers in the 500 to 600 range. And some private lenders don't even have a formal minimum credit score requirement. Now, of course, there's a trade-off. These lenders charge higher rates and fees. Expect to pay a lender fee of up to 5% and interest rates that range from 8% to 18%, depending on the risk profile. But here's the thing. If tapping into your equity at a higher cost unlocks a solid investment opportunity or a second property, it might still make sense, because sometimes the cost of not acting can be greater than the cost of borrowing. Now, those options are great if you need flexibility, but what if you want something simpler? One loan, one payment, and a lump sum of cash you can use right away. This is where our second major strategy comes in. Strategy number 2, cash out refinancing. Cash out refinancing means replacing your existing mortgage with a larger one and taking the difference out in cash. Remember, you can refinance up to 80% of your home's current value. Here's a real Calgary example. Let's say you own a home worth $800,000 and your current mortgage balance is $450,000. You can refinance up to $640,000, which is 80% of the home's value. After paying off your existing mortgage, that leaves you with about $190,000 cash that you can use for your next purchase. The advantage is simplicity. You'll have one mortgage payment instead of juggling both a mortgage and a HELOC. At the time of this recording, 5-year fixed mortgage rates are sitting around 4.59%, and 5-year variable rates are roughly 4.6%. But here's the catch, and it's a big one. If your current mortgage has a great low rate from the early 2020s, refinancing means giving up that rate entirely. And the penalty for doing that could be significant. Variable rate mortgages usually charge a penalty of only 3 months interest, but fixed rate mortgages, well, they charge the greater of 3 months interest or the interest rate differential, the IRD. And that could climb closer to $10,000 or more depending on your mortgage balance. The higher the mortgage balance, the higher the payout penalty. So before you refinance, always call your bank and ask for your payout penalty. It's one quick call that could save you a ton of money and frustration. Now, there's a third strategy that most Canadians don't know exists, and it's one of the smartest ways to upgrade homes or invest without losing your low mortgage rate. Let's talk about that next. Strategy number 3, mortgage portability with additional borrowing. If you're planning to move into a bigger home, there's a feature most people don't even realize their mortgage already has, and it can literally save you thousands of dollars. It's called mortgage portability. Here's how it works. Portability lets you transfer your existing mortgage with the same rate, term, and conditions to your new property and then simply add extra financing for the difference. Most Canadian mortgages include this option, but very few people actually use it because they don't realize they have it. Let's say you locked in a low rate back in the early 2020s. Instead of breaking that great rate and paying a huge penalty, you can pour your mortgage to your new home and blend the new top-up amount with today's rates. That gives you one payment, one blended rate, and a lower overall borrowing cost. Now, there is one key detail you need to know. Timing is everything. Most lenders require that you give possession of your old home and take possession of your new home within 60 to 90 days. If the timing doesn't line up, your lender could treat it as a brand new mortgage and charge you the full payout penalty. So you'll want to coordinate your sale and purchase carefully, ideally with your mortgage broker and realtor working together. But if you pull this off, the mortgage portability can be one of the smartest financial moves you make. Because for homeowners sitting on below market rates, it's a way to upgrade homes and save thousands in interest, all without giving up that great rate you locked in years ago. Step-by-step implementation process. Now that you understand the strategies, let me walk you through the actual process of accessing your equity using a real example from Calgary's current market. The complete step-by-step process. Okay, 5 steps, simple and doable. Step 1, calculate your available equity. In Canada, you can borrow, you guessed it, up to 80% of your home's value. And within that, the HELOC piece is capped at 65%. Again, think of it as 2 buckets. Mortgage and HELOC that work together can only hold 80%. Quick valuation, your city's tax assessment works as a rough starting point. Not perfect. For accuracy, ask your realtor for recent comparable properties. Easy math example. If your home is $100,000, the max you can borrow is $80,000. If your current mortgage is $70,000, you can access $10,000. If your mortgage is $50,000, you can access $30,000. Step 2, choose your bank and product. Big banks like RBC, TD, BMO, Scotiabank, CIBC all offer solid HELOC and readvanceable options. Credit unions and alternative lenders can be more flexible if your situation is, non-standard, like self-employed or you have unique income, but pick it based on best fit, not just the rate. Step 3, gather your documentations. Now here's a typical list. Recent pay stubs, job letter, current mortgage statement, property taxes. If you're self-employed though, expect to provide 2 years of T1 generals and notice of assessments, and potentially 2 years of business financial statements. Step 4, apply and arrange for the appraisal. Now, you're gonna have to submit your application and your documents, and most lenders will order the appraisal after conditional approval. Now, there might be a fee, but ask them if they can cover it, or ask them to credit it back to you at funding. Step 5, review and sign. Make sure you read the terms before you ink it. The rate, the payment type, if it's a HELOC, interest only versus mortgage amortization, check out the fees, the prepayment privileges, the penalties, and whether it's portable and or re-advanceable. If anything is unclear, pause and ask. This is where costly surprises hide. Now, if all of this sounds a little overwhelming, it's okay. My mortgage team can help you set all of this up no matter which province you're in. So contact us in the link below if you want to get in touch. Let's make this real with an example using current Calgary market data, because numbers always makes it easier to understand and see how this actually works in practice. Real Calgary example, Christina's investment strategy. Meet Christina. She owns a home worth $650,000 and her current mortgage balance is $350,000. She wants to buy a rental property and needs about $150,000 for the down payment. Let's start by seeing how much equity she can actually take out. By the way, I have extremely important information about your down payment for investment properties that could make or break your deal, and I'm gonna share that in just a minute. So Christina's available equity calculation is as follows. $650,000 times 65% is $422,500. That's the maximum HELOC amount, okay? Subtract her existing $350,000 mortgage, and Christina has $72,500 available through a HELOC. But remember, she needs $150,000 for the down payment. So the HELOC alone won't cut it. So she has two options. Option number 1 is the refinancing strategy. Refinance to 80% of her home's value. So $650,000 times 80% is $520,000. Pay off the existing $350,000 mortgage, and that leaves Christina $170,000 in cash available. Her new mortgage payment at 4.5% would be about $2,900 per month. This approach gives her the full down payment she needs, but she'll have to give up her original and probably lower mortgage rate. Option 2 is a combined strategy. This will keep her existing mortgage at its great rate, add a HELOC for the maximum available for $72,500, and use personal savings for the remaining $77,500. Now, this strategy lets her keep her current mortgage and take advantage of today's rates only on the smaller top-up portion, creating a lower blended borrowing cost overall. Both strategies get her into the rental market. The difference is in how much she values simplicity versus savings. If she wants one clean loan and one payment, refinancing makes sense. If she wants to preserve her great rate and minimize costs, the combined approach wins. Okay, so many people don't know about this. Unlike buying a home to live in, your down payment with most banks for an investment property cannot be gifted. It must come from your own resources. But whatever path you choose, there are a few critical mistakes that can derail your plan entirely, and in some cases disqualify you from even using your equity. Let's go over those next. Qualification requirements and common mistakes. Now that you know the strategies, let's talk about what it actually takes to qualify and the mistakes that trip people up all the time. First, the big one, the mortgage stress test. You'll need to qualify at the greater of 5.25% or your contract rate plus 2%. So if your lender offers you 4%, you'll be tested at 6%. That higher number can make a big difference in how much you qualify for. Next up, credit score. Traditional banks typically want to see a credit score of 680 or higher to get their best rate. Alternative lenders are a bit more flexible, often accepting scores around 600, but expect to pay a higher interest rate. Then there's income verification. This part's become stricter than ever. If you're salaried, it's usually just a recent pay stub and a job letter. But if you're self-employed, get ready to show 2 years of T1s, notice assessments, and possibly 2 years of business financials. Basically, lenders want to see proof that your income is consistent and verifiable. And don't forget about the costs. You'll likely pay legal fees in the range of $600 to $1,500, plus an appraisal fee of about $350 to $450. If you're refinancing, there could also be discharge fees and payout penalties. So before you move forward, always ask your bank for a full breakdown of the costs. It's better to know everything up front than to be surprised halfway through the process because of a few missed details that can quickly turn a great strategy into a costly mistake. Real world scenarios and strategic applications. Let me show you exactly how these strategies work in practice by walking through real world scenarios using current market data with a particular focus on Calgary opportunities, since that's our local market. Scenario 1, Calgary family upgrading from Cranston to inner city using equity. Meet the Smith family. They bought in Calgary's Cranston area 4 years ago, and today similar homes are selling for around $650,000. And with a $350,000 mortgage balance, they've built up $300,000 worth of equity. Now they want to move closer to the inner city, eyeing homes around $900,000. They want more convenience and lifestyle, but they don't want to wait years to save another big down payment. Their strategy? Mortgage portability. So what does that actually mean? If you sell your home and buy a new one, you can transfer your existing mortgage, same rate, same terms, to your new property. Usually when people buy a more expensive home, they need a larger mortgage. In that case, the new loan amount at today's rate gets blended with your existing mortgage and rate, creating one payment and one blended rate that's often lower than starting over from scratch. This option is typically available through chartered banks and major lenders. I will warn you, if you go with a lender offering the absolutely cheapest rate, they'll likely not have the portability feature. And just like everything else in life, you get what you pay for. I'll be honest, as a mortgage broker since 2012, I've never put myself in with a lender with the cheapest rates. And this is exactly why. Okay, so here's the math. They're gonna buy for $900,000. The equity from the sale is $300,000. The new total mortgage is $900,000 minus $300,000 equals $600,000. Existing mortgage, $350,000 at 2.9%. New mortgage needed is $250,000. That $250,000 portion can usually be set up for any term, 1 to 5 years, and it can be fixed, variable, or a HELOC. If you're buying your first or even second home and think you might move up in the future, make sure you ask your bank if your mortgage is portable. There's no cost for this feature, but not every lender will offer it. Now let's put this into perspective. Their current mortgage is $350,000 at 2.9% from 2021, well below today's average of 4.6. By porting that 2.9% mortgage to the new property and adding a $250,000 5-year fixed rate at 4.6, they end up with a blended rate around 3.7% on $600,000 of financing. This would save them approximately $6,000 for the last year of their 2.9% rate on the $350,000. So after the year is finished, this portion of the mortgage would need to be renewed at the prevailing market rates. But what about someone who wants to use Calgary's relatively affordable prices to start building a rental property portfolio? The numbers look quite different for investment properties. Scenario 2, building a rental portfolio starting in Calgary. Meet Sarah. She's a marketing professional living in Calgary's Beltline, and she wants to start building wealth through real estate without selling her home. Her condo's worth around $420,000. Now, lenders will let you refinance up to 80% of your home's value. So in Sarah's case, 80% of 420 is about $335,000. That's how much total financing her condo could support. She still owes $240,000 on her mortgage. So 335 minus 240, which means she could access roughly $95,000 in equity. Here's where it gets interesting. To buy a rental property in Canada, you need a minimum of 20% down. And since she has about $95,000, that's enough for a $480,000 rental property. That means she'd need a new mortgage for the remaining $385,000. When you combine that with her refinanced $95,000, she's essentially financing the full $480,000 purchase price. At 5%, 5-year fixed rate with a 30-year amortization, her payments would be around $2,560 a month. So her next step is simple. Find a rental property that brings in at least $2,560 per month. That's the key to breaking even or even cash flowing while using the equity from her condo to start her real estate portfolio. Now, when I run cash flow analysis, I like to keep things simple. I only use 3 main costs. 1, the mortgage, 2, property taxes, 3, insurance, and 4, condo fees if you're buying a condo. That's it. I give the tenants to set up their own utilities, and if it's a detached home with multiple tenants, they can split those costs amongst themselves. Now, some investors like to factor in a 3% vacancy rate or a maintenance budget. Personally, I don't, but that's totally up to you. There's no right or wrong way to do it. Now, if you hire a property manager in Calgary though, expect to pay anywhere from $500 to $1,000 upfront for tenant placement and about 10% of your gross monthly rent after that. In my experience, if you hire a professional property manager, you typically won't cash flow if you put 20% down. It would need to be more. By the way, if you want to learn the difference between investing in condos, townhomes, and detached homes, and the returns of each, check out this video up here. I break down all 3 options and some of the results might surprise you. And here's a quick tip. If you buy a detached home, you can create 3 streams of income. 1 from the main floor, 1 from the basement, and the 3rd one from the detached garage. If you want more tips like that, make sure you watch that video next. Now, let's look at how someone can use equity strategically across different Canadian markets. This is where the real opportunities for wealth building becomes apparent. Scenario 3, cross-market investment strategy. Meet David and Jennifer. They live in Toronto and bought their home for $900,000 years ago. Today, it's worth $1.15 million and their mortgage balance is around $680,000. They want to invest in real estate, but not in Toronto. The prices are too high and the cash flow is tough. Instead, they found a great opportunity in Calgary where returns are much stronger. They came across a real 4-plex in Killarney listed for $1.2 million at the time of this recording. Here's their strategy. It's called the cash out refinance combined with cross-market investment. They'll refinance their Toronto home to pull out equity and use that as a down payment for their Calgary property. Let's break it down. Their Toronto home is worth $1.15 million. So to refinance it 80%, that's about $920,000. They currently owe $680,000, which means they can access roughly $240,000 in equity. Keep that number in mind. $240,000. That's important because you need at least 20% down for investment property in Canada, and $240,000 is exactly 20% of $1.2 million. So here's how it works. They'll take the $240,000 they refinanced from the Toronto home and use it as a down payment on the Calgary 4-plex. That leaves a $960,000 mortgage on the new property. And between the refinance equity and the new mortgage, their total monthly payments are $6,400. Now let's look at the income side. This Killarney 4-plex currently brings in $7,640 a month in rent. Here's the cash flow breakdown. $7,640 in income, minus $6,400 for mortgage payments, minus $530 for property taxes, minus $335 for home insurance. That leaves a positive cash flow of roughly $375 per month. So even after refinancing their Toronto home and buying a property in another province, David and Jennifer are still cash flow positive, around $350 to $400 every month, while owning 2 properties in 2 different markets. Sounds great, right? But here's the catch. The rules change the moment when you cross a provincial border. Provincial differences and market opportunities. Now, here's where things get interesting. These strategies don't work the same way across Canada. Every province plays by its own set of rules. And depending on where you invest, those rules can either boost your returns or hold them back. So let's break this down. In Ontario, the market is very tenant-friendly. Maybe a little too much. There are strict rent control rules. Landlords can only raise rent once a year, and even then, only by the small percentage the province allows. British Columbia is similar, with annual rent increase limits under their Residential Tenancies Act. Nova Scotia also jumped in, adding a temporary 5% rent cap that's in place until the end of 2025. And in Quebec, tenants can actually refuse a rent increase, which is bananas. And then it goes to the rental board to decide what's fair. Now, let's talk about Calgary. This is where things really change. Alberta is one of the most tenant-friendly provinces in the country. It's like the wild, wild west out here. There is no rent control. None. Zero. Zilch. You can adjust rents to match market conditions and inflation, and you just have to give proper notice and wait at least 12 months between increases. Now, that flexibility gives Calgary investors a huge advantage, especially in a market that's still growing fast and attracting people from all over Canada. Tax implications vary by province as well, and there's one major cost that varies by over 400% depending on where you're investing. Land transfer tax savings in Calgary. Now let's talk about another big difference between provinces. Land transfer taxes. These can vary a lot and they can have a real impact on your returns. Take Ontario for an example. You'll pay anywhere from 0.5% to 2.5% of the purchase price depending on the property value. And if you're buying in Toronto, it's even worse. The city charges its own municipal land transfer tax on top of that, basically doubling the cost. Over in British Columbia, it's 1% on the first 200,000, 2% up to 2 million, and 3% above that. And if your property is over 3 million, that's another 2% added on top. That's up to 5% in total. Now, here's where Calgary really shines. Alberta has no land transfer tax. None. Instead, there's two small fees. First, a land registration fee. It's about $50 plus $2 for every $5,000 of property value. And two, a mortgage registration fee. That's roughly $50 plus $1.50 per $5,000 of mortgage amount. For a $500,000 property, you'd pay over $13,000 in land transfer taxes in Toronto, around $10,000 in Vancouver, and in Calgary, $450. That's it. And if you're building a portfolio with multiple properties, those savings can literally cover a big chunk of your next down payment. Calgary's investment opportunity. Now let's talk about why I think Calgary offers one of the best opportunities in Canada for equity-driven real estate investing. There are a few key reasons, and they all come down to strong market fundamentals. First, let's start with vacancy rates, because they tell you everything about supply and demand. According to CMHC, Vancouver sits at 1.6, extremely tight. That might sound great, but it also means prices are high and there's potential oversupply risk as more projects finish construction. Toronto is sitting at 5.5 vacancy, which isn't actually that bad. It gives investors room to find deals, but you're still competing in one of the most expensive markets in the country. Now, in Calgary, it's 4.6 vacancy. That's kind of the sweet spot. It's balanced, not oversupplied, not struggling for tenants, just a healthy market where new investors can still find opportunities and solid renters. Let's add in population growth, because this is where the story gets even better. Calgary's population grew by 6.1% year over year and almost 18% over the past 5 years, reaching 1.6 million people in 2024. That is massive growth. And it's not just from people moving across Canada, it's also being driven by immigration and economic diversification. Alberta's been pouring investments into tech and innovation hubs, expanding creative industries and even developing renewable energy sectors. Combine that with Canada's immigration targets, 395,000 new permanent residents in 2025 and 380,000 in 2026, and you have a steady pipeline of new renters. And where do most new Canadians go when they first arrive? To affordable, opportunity-rich cities like Calgary. But there's one more factor that most investors completely overlook, and it can make a huge difference in your overall returns. Economic diversification and infrastructure investment. Calgary's economy is rapidly evolving beyond oil and gas. The city is becoming a major tech hub, attracting new venture capital, expanding film and television production with enhanced tax credits, and growing renewable energy sectors that are bringing new jobs and new industries. Then there's the infrastructure side, and this is big. The Green Line LRT will connect downtown Calgary to the southeast and the north, which could have major impact on property values along the route. The Calgary Airport expansion and the Trans Mountain Pipeline completion are also creating new jobs and economic momentum across the city. All of this points to one thing. Calgary isn't just about better cash flow today, it's about setting up for long-term growth in population, employment, and rental demand. When you combine these fundamentals with equity strategies we've been talking about, the opportunities become even more exciting. Using equity from expensive markets like Toronto or Vancouver to invest in affordable, high-growth cities like Calgary can dramatically accelerate your wealth building strategy. Rezoning and densification. Calgary is focused on building both out and up. While there are new communities expanding outward, many in the north, there's still a huge group of people who want to stay close to the city center, or what we call the inner city. That opens up really interesting opportunities for investors, because right now you can buy a detached home, rent it out, and years from now you can tear it down and build an 8-unit complex on that same piece of land. This taps into one of the most powerful principles of real estate, the highest and best use, which simply means finding ways to maximize the value of the land over time. If you wanted to buy one of these properties today, these 8-unit places, they're selling between $3 million and $3.3 million. And if you want to get updates on these properties like this, just use the link below to get in touch and we will send you the most recent ones. Considerations you need to know. Now, it'd be a lie if I told you that investing in real estate is all sunshine and rainbows. There are a few things you really need to understand before jumping in, because if you're not careful, the same equity that can build your wealth can also become a financial headache. Let's start with one of the biggest factors most homeowners underestimate: interest rate sensitivity. Most Canadian mortgages are fixed for only 1 to 5 years. When that term ends and you renew, your payments can jump fast if rates have gone up, and that can be a real shock. Let's put some numbers behind it. If you have a $400,000 mortgage at 3%, your monthly payment is around $1,890. If that renews at 5%, your payment goes up about $2,325. That's an extra $435 a month, every single month, just because of higher rates. Now, let's talk about HELOCs, because they're even more sensitive. HELOCs are variable rate loans tied directly to the prime rate, which means if rates rise, your payments also go up immediately. Here's something you might not have known. The Bank of Canada has 8 interest rate announcements per year when they want to change rates, and they usually change them in increments of 0.25%. So for example, if you borrow say $150,000 at 4.7% and rates climb by 2%, your monthly payment increase can be up to $175. And if you own multiple properties, those increases can add up fast. Could rates actually go that high? Maybe, but personally, I'm not overly bullish on the Canadian economy right now, especially with all the debt we're carrying. Here's a quick tip. Always run your numbers, assuming interest rates are 2% higher than what they are today. If the deal still makes sense, you're likely in a safe zone. But if it doesn't, then before you sign, maybe rethink the investment before you commit to it. But interest rates aren't the only thing that can catch investors off guard, especially if you're buying a market outside your own backyard. And this one can completely derail your investment strategy if you're not prepared. Regional economic dependency. A lot of smaller Canadian markets depend heavily on one or two key industries. While Calgary has diversified a lot over the past decade, it's still influenced by the energy sector. So if that industry slows down, the local economy will probably feel it. Market corrections are always a possibility, especially with high household debt, rising mortgage renewals, and affordability pressures across the country. If a correction happens, you could see declining property values, longer selling times, tighter lending conditions, and in some cases, even negative equity, where you owe more than the property is worth. Remember, leverage amplifies both gains and losses. It can build wealth fast, but it can also magnify risk if the market turns against you. That's why it's so important to diversify across different markets. It helps protect you if one region or sector takes a hit. The next consideration is a big one and is something many investors overlook until it's too late. And it has to do with regulatory and tax changes that can dramatically affect your returns. Regulatory and tax changes. One of the biggest threats to rental property returns right now is rent control expansion. We're seeing more discussions across Canada about stricter tenancy protections and rent increase limits. While Alberta currently has no rent control, that could change if political winds shift. Then there's mortgage regulation. The federal regulator OSFI often reviews lending rules and changes like tighter qualification requirements or lower loan to value ratios that can make it harder to access equity or buy additional properties. And don't forget about the tax changes. There's ongoing political pressure around housing affordability, which means the government could change how capital gains, expense deductions, or even investment property taxes work in the future. The key takeaway: always try to factor in regulatory risk. I mean, don't assume today's rules will stay the same. Make sure your investments can still perform even if things tighten up. Selling in a buyer's market. Real estate values tend to rise over time because of three key forces: inflation, the cost of materials and labor, and scarcity. There's only so much land to go around. But the truth is, none of us really know when we'll eventually sell a property. And because of that, we don't know what kind of market we'll be selling into. If you're not in a rush to sell, this isn't a big deal. You can wait it out for a downturn. But if life forces your hand and you need to sell during a buyer's market, you're kind of at the mercy of whatever the market is doing at that time. That's why it's so important to plan your exits carefully and avoid over leveraging, so you're never forced to sell when conditions aren't in your favor. After walking through all of these strategies, market data, and real world examples, here's the bottom line. Your home equity is one of the most powerful tools for building wealth, but only if you use it strategically and understand the risks that come with it. The three main strategies we covered: HELOCs, cash out financing, and mortgage portability. Each serve a different purpose. HELOCs gives you flexibility. Refinancing offers simplicity, and portability helps preserve those great low rates you might already have. Which one you choose really depends on your situation and your goals. Keep these key numbers in mind. You can borrow up to 80% of your home's value with a 65% limit for HELOCs, and you'll need to qualify under the 5.25 stress test rate or the contract rate plus 2%. And if you're buying an investment property, you'll need at least 20% down, and the down payment needs to come from your own resources. These are not suggestions. They're pretty hard limits that shape what's possible. Calgary in particular has some serious advantages. There's no land transfer tax, saving you thousands on each purchase. There's no rent control, giving you full flexibility with rental income. The city's seeing strong population growth, but before tapping into your equity, have a clear plan. Know your total costs, stress test your numbers for higher interest rates, and when you're buying investment properties, run conservative projections that account for changing rental markets. The people who succeed with these strategies treat home equity like a business tool, not free money. They understand the costs, manage the risks, and have realistic timelines for their goals. If you're ready to see how these strategies could work for you, our LiveInnerCity Real Estate team can help you map it all out. We'll show you how to turn your home equity into a clear step-by-step plan that accelerates your path to financial freedom, not guesswork, just strategy. Reach out at hello@liveinnercity.com and let's figure out how to make your equity start working as hard as you do. Your home equity represents years of effort, discipline, and belief in your future. Used right, it can collapse decades of waiting into just a few short years. The opportunities are here. The question isn't if you can build wealth, it's whether you'll take action while the window's open. And remember, your home isn't just where you live, it's the foundation of your financial future. Don't just live in it, leverage it.